and welcome to the Weekly Watch, where we help you cut through the noise with our quick take on the biggest events moving global markets. I'm Imogen Bachra, UK rate strategist, and I'll be standing in today for John Briggs. Before getting into today, just please remember to subscribe to our channel so you can get the latest episode the moment they're published, and hit the like button so the Weekly Watch is easier for others to find. Okay, another super volatile week in markets, which has seen big moves in risk asset space and in fixed income, but with really little or often no news flow. It's been risk assets that have left the way, with markets kind of weighing up concerns around upcoming growth risks in the face of still very high inflation and central banks shifting ever more hawkish against that weakening growth backdrop. Last week we had the RBNZ, Norges, Riksbank, all surprising on the hawkish side. And this week we've had Malaysia joining the growing pack of central banks to hike unexpectedly. On the global growth front, we think that China remains the big question mark. A pivot to a broader growth stance would obviously be risk positive, but so far we think that large-scale stimulus like in 2008 and 2009 is still unlikely. We've had comments from the State Council this week which suggested the early signs of a shift towards employment targets and away from growth targets kind of reinforce that view that perhaps large-scale stimulus is unlikely. More locally, UK GDP growth came at the lower end of consensus, reflecting the underlying moderation in growth in 2022 and the weaker outlook for the rest of the year, which reinforces our view that the Bank of England will pause its monetary policy tightening after August, with the bank rate at 1.25% to allow time to assess the damage to demand. On the inflation front, the main news this week was out of the US, where inflation was firmer than expected, and with the drivers of that inflation print this month skewed again towards more services than goods. Ultimately, this is probably unlikely to change the outcome for the Federal Reserve's meeting in June, where, as a reminder, we're expecting a 50 basis point hike, but it does create a problem for the Fed in that the acceleration in the core data, and more specifically in sticky categories like rent, is exactly the opposite of what they would like to be seeing in the inflation data right now. So for us, it's kind of hard to see how the discussion of 75 basis point hikes won't be making a comeback for the July meeting, particularly if the June release looks anything like today's print. And that June release does come ahead of the June central bank meeting. So we'll be on the lookout for local Fed presidents to publicly discuss the possibility of 75 basis points more frequently over the coming weeks. It's been the ECB probably, though, this week that's been the most vocal about that kind of direction of travel of policy, and perhaps have done a bigger pivot than other central banks have. So I'm happy to be joined today by our chief Euro area economist, Giovanni Zanni, to talk a little bit more about that. So Giovanni, like I mentioned, we've had lots of hawkish rhetoric this week from ECB members, not just the hawks, but also the doves seem to be on the same page now. We had Lagarde yesterday, who firmly put July on the table as a possibility for a first rate hike. Is that now your base case?
Well, I would say yes. I mean, as you said, I mean, there were so many doves and hawks, coming out in unanimity, unanimity that we hadn't seen for quite a while in the council, and so we can't ignore that. So I would say the path of least resistance is to have a rate hike in July, of course, unless there is a big deterioration in activity between now and July, financial distress. And again, this is not impossible. I mean, this is not impossible because we've seen that the IFO survey has gone to depths that it normally reaches only in quite chunky recessions. Global trade indicators are not looking very good. Consumer confidence is also quite depressed, and we've seen some cracks also on the financial condition indicators. So, I mean, all this gives you a little bit of doubt for July, but otherwise, yes, I mean that should be the best option. The other point I would say is that apart from July, there is a question for the rest of the year, because the markets are still expecting between 3 and 4 rate hikes. And to be fair, if I had to give an assessment and a distribution of probability, I would say it's more likely that we'll only get 2 that we would get 4 or even 5.
Just sticking with the timing of July for now, what will you be watching most closely between now and then, or in the weeks leading up to that meeting, that you think will be key to determine whether the ECB hikes or not?
Yeah, so from what I said, I mean, I think that the most relevant data will be the activity data, so surveys, industrial production, consumer confidence, and also the financial side of things. So if there is more signs of financial instability and stress. And then you have things like what happens to the situation in Ukraine, of course, what happens also to government decision. But I would say activity data is really the kind of potential driver for changes at the ECB right now. It's the main one.
And touching on the point that you made just before then around, what the market is pricing in beyond July, moving away from just the timing of liftoff, I suppose, where do you see neutral rate or the terminal rate getting to in this cycle? Markets are probably close to, about 1.5%, I suppose, over the longer term. Does that seem fair to you, or do you think that again is too much being priced in?
No, I don't disagree with 1.5. Actually, probably 1.5 to 2% is the right ballpark for a neutral rate for the euro area. My point is that will we get there in a kind of linear way? Is it going to be in this cycle? And then I'm less sure. I mean, there are a lot of things that we are unwinding in terms of support to the economy, and we don't know how the economy is going to react on top of all the other uncertainties that are there. So, I mentioned 2 rate hikes for this year as more likely, and I would say that probably moving along this path in 2023 is also likely. We've put as a central scenario 4 more rate hikes, but we still not get to 1.5 or higher by the end of 2023 for the reason I mentioned before. So that there is still not such a clear and simple path to that steady state that at some point, yes, will be there.
Yeah, thanks, Stuart. So there's a lot to watch then in the next few weeks for the ECB, but also for other central banks as well. As I mentioned, we'll be watching closely the language of local Fed presidents to see how that narrative around 75 basis point potential hike might shift. And next week, we also have a heavy data week in the UK. We get wages and employment and inflation data, as well as growth data out of Europe. So a lot to be watching for central banks over the next couple of weeks. All right, I think that's all we have time for today. Thank you for joining us, dear, and thanks to all of our listeners for tuning in. I hope you have a great week.